All right. Everybody stand up? Yes, thank you, sir. Two claps. Two claps. Two claps. How we doing? So Tuesday? Two clap Tuesday. Two claps. All right, sit down. All right. I'm going to try not to reverberate here. We'll see what we got going on here. All right. Can everybody hear me okay? It's okay? All right. Jake, you good? All right. Jake's my cameraman tonight. Miss Laura wasn't feeling quite very well, so he doesn't look as pretty, but he'll do. So anyway, all right. Now, who brought your brain tonight? Me. Everybody bring your brain? I brought my brain. This is a little squishy. Okay, a little squishy brain. I brought my brain. Okay. This is the last night together. Oh, I know. Now, if this is everybody else's first time, welcome, okay? But the rest, who's been here most every night, this is our last time together doing financial fundamentals, because it's fun, right? True. Have we had a good time?
Yeah.
I've had a great time. We've both put in a lot of work together to pull this off, but I've enjoyed it. So I hope you guys have gotten a lot out of it. And so let's talk about our homework. Let's see how much y'all have gotten out of it. Okay, it's like a pop quiz. Who done their homework? Okay, who's done it? All right, so has anybody set up their special emergency fund account? Who's done it? Confessions, you already had it. Okay, some kind of separate account just for emergencies. How about Credit Karma? Who's looked at their credit? Anybody done that? I heard through the grapevine that somebody worked on their credit score. Who was that? Who improved their credit score since we were here? Nobody's gonna fess. Aha, who? You did? Good, how'd it work out?
Good.
Good, getting better?
Yeah.
Knocking it out. On the way to 800?
Yeah.
That's where we wanna go, on the way to 800, that's awesome. How about, I gave you some homework to track a couple little stock funds. Did anybody do that? Ouch. Kason, good man. Did we make money or lose money these last 2 weeks?
I made money.
You made money. Well, everybody else who tracked the fund lost money. Okay, we're going to talk about that. Good. All right. And then who set up their budget? Suggs, good. Good. Andrew said he set up his budget. He's working through it, so that's good. And track your spending. And who has subscribed to the Rocket Guy? Because I'm trending with like 60 some odd subscribers now. We are rocking it out in 28027. So it's awesome. Scoring it out. Okay, so here's where we've been. We talked about stewardship. Who owns it?
God. The Lord.
The Lord owns it. God owns it. What do we do? Who are we? What do we do?
Manage it.
We're managing, right? God owns it. We just take care of it. That's what we do. Do we give or keep?
Give.
It's God's, right? So if we have an opportunity to give, we're going to give. We're going to tithe. We're going to offer. We're going to take care of our friends and our family and other things like that. And then we talked about income, spending, and debt. This is where it gets into the budgeting and making some room, right? Can we do anything else if we're too tight on our budget? Can we save? Can we invest? Can we give? No. So we have to live within our means. Some people might say we need to act our wage, okay? And then we talked a little bit about saving last time, and then tonight we're going to talk about the big boy, which everybody started off running in here going, hey, should I do like a 401k, IRA? What should I do? Right? That was like week one. We had to get there, okay? So we're gonna talk about that a little bit. And so why are we doing this? Why do we want to pay attention and be intentional about our finances? I've had this slide up like every week, okay? So why? Because I always feel like the why is very, very important. So why do we want to do this? It's because the crazy people over here on this side, the average, the normal, right? The normal people spend way more than they make and they save nothing and they have no money. They have no flexibility in their budget. They have no options, okay? So we don't want to be these people, right? Where the road is wide and easy and you go to the concerts every night going, ooh, right? And you have no money, okay? That's not what we want to do. We want to be exceptions to the norm. We want to be exceptional people, exceptional managers, and we want to be financially secure, have our options, and be ready to listen to God's calling. Okay? That's what we want to be over here. We don't have to be old to do that, by the way. There's an old guy there, okay? Kind of looks like me and Chris sitting on the dock on the bay, right? Okay? You don't have to be old to do this. Okay? So let's dig into investing. What are we going to dig into? Investing. Everybody ready? You got your brains on? Okay. So here we go. So last time we talked about, we focused mostly on this saving side, right? These are the pillars of where we put our money. Remember that? These are the pillars. And last time we kind of spoke more about kind of that emergency fund, savings, a little extra in our checking account. Right? We talked about that. So this time we're going to talk about what happens over here on the right. Okay? Is that good? Everybody good? All right. So let's talk about the difference. Because there are differences between saving and investing. Okay? Saving is for security. Immediate needs. Here's where I'm at. I need help. I got to reach into my savings account. That's what savings is all about. Just a buffer. Remember last time we talked about an airplane that flies low, doesn't have any room for any mistakes. Airplane's way up high, 30,000 feet, you got plenty of time to think as you're falling down to the ground. You got plenty of time to think about it, okay? So yesterday when I was flying at 19,000 feet back from Alabama, I was like, wow, got plenty of time to think about this one. But savings, that gives us short-term security, okay? Short-term security. Investing is long-term. I usually put it out like 12 months plus, okay? Doesn't have to be retirement, just has to be longer than a year. Is that good? Some people think about investing like when I'm old, like I'm walking through the hallway with my walker on, okay? And I'm just screeching along with my little scooter through Walmart, okay? That's not really what investing is necessarily. That's a part of it, but it might be, hey, I just want to put some money aside to buy a house, right? It might take me a few years. I don't want it not earning interest. I want a return. I want to put it somewhere where it's going to grow. And that's investing. Everybody get that? Right? So investing, oh dang, Kevin. Oh, where's my?
You need it? I'll get it.
No, don't get up, because I'll be back. I'll be away from here by now. All right, so let me do this. Here's my picture. Okay, look, here's what I was going to draw on the board. Okay, investing is this balance between risk and return or reward. That's what investing is. It's a constant balance. What happens as the reward goes up, the return goes up? What do you think happens with risk? Risk and reward. Okay, let me put it this way. All right, if I wanted Tucker to invest in something risky, am I going to give him a big return or a small return for his efforts? Big, right? If it's super risky, I better pay him a lot of interest because he's sticking it out there for me. Okay? If it's like, it's not real risky at all, like a savings account, do they pay you a lot of interest or no interest? Well, basically nothing. 0.0005%. Okay, that's what I just saw on the E-Trade banking the other day. Okay? Thank you, Kevin. So when we're investing, right, we're always looking at risk versus reward. Okay? Now, as your risk goes up, the reward should go up, match it. Okay? As an investor, I should feel like I'm getting a bigger reward for my risk. If the risk goes down, then my reward is probably also going to go down. So a savings account, are you going to lose any money? Nah, it's not much at risk. In fact, the Fed insures it for up to like $250,000 or something per account. Okay, so unless you invest more than $250,000 in your savings account, and if you do, I will smack you in the head. Okay, because it shouldn't be sitting there at 0% interest. Okay, so they're going to pay you for low risk. Your reward might 0.05% is what I saw the other day for a savings account. Okay, so low risk, low reward. But if you do some very risky investment, right? Suggs, you're doing some very risky investment in some kind of crypto something or other, right? Then you best be getting like 20% or something, because you have it all at risk. It is all in, okay? All at risk. So you better be getting some huge reward, okay? So that's the way investors think. That's the way investors think, and that's how we are going to think as investors. Is that good? So what are we trying to balance out? Risk and reward, okay? In saving, all we're trying to do is just protect from risk. That's it. There is no real reward. It's just, hey, I know I've got emergencies coming, so I'm going to set some aside and I'm just protecting myself. Is that fair? Everybody get that? Okay, good. So that's kind of the difference between a saver and an investor. Okay? Did you like that? It was like the behind the back shot. Did you see that? That was pretty slick. Yeah, I can't dribble, but I could do the thing. Okay. So let's talk about different types of investing. Okay? And I brought some examples just for fun and giggles and grins. Okay? So most time when people say I'm investing in something, they think about like what? Give me some examples. Yes, Jay.
Stocks, bonds.
Stocks, bonds. We call that paper assets. Why do we call it paper? Because you know what? It's on paper. This is a share, 3 shares of Disney stock. Isn't this pretty? It's got like Mickey Mouse and stuff on it. Isn't that pretty? Isn't that pretty? So my mother-in-law gave this to us for some like, I don't know, anniversary, something or other, long time ago.
It was your wedding.
Well, because we were married, it wasn't at our wedding. And I get like $1 a year or something in dividends. Okay, that's awesome. We'll talk about what that is. But these are paper assets. So that's pretty cool. So I'll let you look at that. If you take it, I will break your knuckles. Okay, and then this one, I really don't care if you take or not. This is a paper share of a company I invested a lot of money into, and it went bankrupt. Okay, and I lost all my money. So this is awesome. So it's really of no value. But this is a paper asset. This is a kind of a private investment. Okay, Disney is public. You can buy it on the stock exchange. Right? We're going to talk about that. This is private. Okay, and then this is a stock certificate for one of my companies. This is very valuable, so please don't take it. And so this is one of my companies that I own with a stock certificate. So these are paper assets. Now these are stocks. Now most of the time when you buy a stock, do you get the piece of paper? Do you know? No. Right? It's just like anything else in today's world. It's like electronics somewhere. It doesn't really exist. Okay? Another example of a paper asset is what's called a bond. And we're going to talk about the difference. But when I was born in November of a year not to be described, my great-grandfather, Pops Willis, okay, my great-grandfather bought some savings bonds and gave them to me. Okay, this is a U.S. savings bond, $25, issued a few years ago when I was born. It's now worth $25. Okay, so it's not worth much, but this is our pizza money for the next time we go out. Okay, but this is a savings bond, so I thought this was a real neat thing. So these are kind of paper assets. Why are they called paper assets? They're on paper. Okay, easy. Are we passing the test? Okay, this is easy, right? So there might be other things we can invest in. And remember, guys, this is all based on your education, right? Who wants to buy a train load of oil? Okay, corn, wheat, soybeans. Okay, those are commodities. You can actually buy and sell commodities. If you end up actually owning it, yes, a train will have to come and you own the corn. Okay, but that gets real risky. Okay, real risky stuff, but you can do that. How about real estate? This is my fave. This is my BFF. Okay, is that still a term? Anyway, it is for me. So real estate is my friend. Okay, and I'll talk to you about some of the things I own in a little bit. But real estate, that's my friend. Asset or liability? We talked about that before. What's an asset?
Make money.
What's the liability? Costs you money. Okay, and real estate can be both. Okay, my favorite real estate as an investment, we invest in assets, things that make us money. So when I talk about real estate, I'm not talking about your personal mountain home that you go to 3 times a year and it costs a fool out of you the other 360 days. Okay, I'm talking about income producing, making you money kind of real estate. Okay, that's what I do. How about the next one? How about some gold and silver? I don't have gold, but I do have silver with me tonight. So this is 1 troy ounce of silver, properly tarnished and everything. Okay, I don't buff my silver. This one, I looked it up. This thing's worth about $27 maybe an ounce, I think is what it is nowadays. So this was given to me by a friend on my 13th birthday, so just a couple years ago. Okay, I keep stuff. Have y'all noticed? I keep stuff. So But this is an asset. One day I might need to trade this for some corn, okay, that I bought on the commodities exchange. But anyway, so y'all can take a look at this. So coins, metals, precious metals. How about collectibles? Exotic cars, stamps.
Cards.
You know cars? What? Yes, the die-cast race car cars, okay? So people get into that, and that can be an investment. Could also be a big loser, right? So you got to be kind of careful with that. People have made a lot of money on baseball cards. People have also have shoe boxes of baseball cards that aren't worth anything, okay? So different investments. But most people think about investments being the paper assets. When you talk about, hey, I'm investing my money, most people and the common person thinks about paper. Is that fair? That's how we do. So that's what we're going to focus on most of tonight. If you want to talk about real estate, we can watch this. Whoop. Okay. If you want to talk about real estate sometime, we can do that. So let's talk about the difference between stocks and bonds. Okay. Stock, bond. Okay. A stock, when you buy a stock, you actually own a piece of the company. You own it, right? So I can walk into a Disney World and go, I own this place. Look at this, is awesome. Where's my bathroom at? Somebody tell me where right? Because you own the place. Now you and 100 million of your closest friends own that business. How many ever shares there are, okay? So, but you own a piece of that business when you buy a stock. Is that easy? That's easy, right? Now, here's the kicker. This company that I lost all my money in, they don't own the money back. They don't owe it back. You gave it to them. The trade was this piece of paper. That was the trade, right? They don't owe anything back to you. So if they go out of business, your money go bye-bye. That works. Poof, all gone. Okay, that's how it works. Okay, they don't owe you anything except for a share of the profits, or if the value of their company goes up, your value of your stock goes up. Is that good? Okay? So I can't remember what we paid for Disney, or my mother-in-law paid for Disney a long time ago, but as that share price goes up, our worth in this little piece of paper goes up. Yes?
Okay, so say the business goes under, they have a lot of debt, they have to liquidate all their assets. If any of the profits are still remaining, do the stockholders get some of those liquidated assets?
No, they're gonna, usually when it happens, if they really truly go under, they have nothing to sell. There's nothing to do. Okay? If they go bankrupt, it's because they owe more than they have. Stop!
Dumb it down.
Dumb it down. Yeah, dumb it down. Okay, yes, question.
The thing that I've seen, especially more recently, like there was the 2008 retail crash, and the more recent one was the huge GameStop stock issue.
Yep.
At what point would you say it's far too late to even consider investing in a company?
In a particular company, your last chance of investing is right before it falls. And nobody knows when that happens. Okay? And that's why we're going to talk about that, because some of that stuff is gambling, it's not investing. Right? And when you go to the poker table in Vegas, that's gambling. When you buy a GameStop and you know because everybody on the TV is talking about it and you're only buying it because people on the TV are talking about it, that's gambling.
Yeah.
Okay? So, and that's the difference between gambling and investing, because you don't know when the ride's going to stop and you're without a chair to sit in. Okay? You ever play musical chairs? And that's what happens. You're trying to sell your stuff, there's no buyers. You have no chair to sit in and you're stuck. Okay? Bonds. Bonds. Okay? Stock is ownership. A bond is a loan. Bond's a loan. I loaned this company money. They owe it back. They owe it back with interest. Okay, is that fair? Stock is ownership, or what we call equity, right? A bond is debt. A bond is they owe you money back. Okay? Now companies really only raise money two ways. What are they?
Selling stock.
Stocks and bonds, okay? They either issue stock or they borrow money. That's how companies raise money to grow. That's the whole point of investing, is to help these companies to grow. That's it. That's it. That's all. The only reason why they're out there. Yes?
So the company doesn't have to pay you for their losses, but when you invest in a company, you're giving them money. So when you sell a stock, are you taking money out of their account?
No. Because what happens is during that issue, during that initial issue, that's when they're pushing shares out into the marketplace. In that IPO, the initial public offering, they're pushing shares into the marketplace. After that, it's trading between buyers and sellers. It doesn't come back to the company. They got all their money then.
So it's just to predict the value of the company?
Yep, that's all it is. That share price is an auction between willing buyers and willing sellers and where the auction settles. You ever been to an auction? Right? Been to an auction of like a piece of farm or something like that. Hey, give me five, give me five, I give me five, give me four, right? That's kind of what they do. It's an auction. We're going to talk about that in a minute. Okay? And that share price is really where the buying and the selling settle out. Is that fair? All right, now, last term. If you can grasp these three terms, you can be an investor. Is that fair? It's easy. Mutual fund. Mutual. It's just a group of stocks and bonds. That's it. They package a bunch together and they sell that package. That's it. Mutual fund. You'll hear this a lot. Don't you want a fund? You want to invest in the fund? What does that mean? Well, it just means somebody put together a group of stocks they like, group of stocks and bonds, some kind of mix, and they go, would you like to buy a share of my mix? Okay? And you're like, yes, I like a good mix. I like mint chocolate chip, please. That's what I like in a good mix. Okay? And that's what a mutual fund is. So you can invest in stocks, you can invest in bonds, or you can invest in mutual funds. Okay? That's it. We're all done. Is that good? All right? So let's talk about it. Yes, Jake, did you have another question?
Yeah, okay, this is what bad mutual funds what led to the crash of Wall Street.
No.
Where they were doing like double A's and triple A's.
No, that's bad bonds. Okay? And derivatives on bad bonds and derivatives on the derivatives and insurance products on the bad bonds. Listen, let me tell you something. Here's the deal. Okay? I want to give you a hint. This is spoiler alert. Spoiler alert. Okay? There are people that spend their entire college careers and graduate school learning finance, learning this stuff. All right? Got it? Okay? Yes. Yeah, I'd take, please, $50,000 per. It's my investment, and y'all give it back. No. So this can be extremely complicated. The other part is this, is that all this stuff is created by sales guys. I are one, I know how this works. Sales guys sit around a table and they come up with something to sell. And then they go out into the marketplace and they sell the fool out of it and they put all the money in their pocket. This is how this works, okay? Another spoiler alert is that the system is kind of rigged, okay? But as long as you know how it's rigged, you can play it and make a lot of money. Is that fair? Okay? So don't try to beat the system, just try to ride the system. Okay? I hate to be that way, but when you do some homework and listen to what I have to tell you, I think some of the more mathematical people in the room will figure it out. I want to have to show you. Okay? So what's the stock market? Is everybody good? Y'all tracking? What's the stock market? Huh? What's that? Everybody says, I'm on the stock market. What does that mean? What is the stock market? Well, it's easy. It's just a place where companies go and sell their yes, to raise money. That's what they do. It's the stock market. Okay? It's kind of like stock was cattle. Ooh. And you go to the stock market to buy, sell cows. Okay? All right, same kind of thing. It's an auction. It's an auction in most cases, right? Sometimes it's an auction on the floor, like the New York Stock Exchange. We'll talk about that. It's actually a literal auction, right? You go up and go, hey man, I got something to sell. The guy tries to sell it for you. Okay? And in other marketplaces, it's more like a dealer. Like you have to work through it and you pay him a commission. Okay? Yes?
Can you explain the differences in stock between a publicly held company and privately held?
Sure. So a private company like these two, right? It's not publicly traded. Okay? And a lot of times you have to be an investor of a certain income or a certain worth to even qualify to buy this. And we're going to talk about that. Okay? Because that's important to know. Right? But there are only a few shares and you're kind of limited to who you can sell it to. Okay? if you're buying something in a public company, it's open to the overall market, right? You can go on E-Trade right now and you can buy a share of Disney. Is that fair? I don't know. Somebody can look it up. So tell me what the price is. Huh?
189.
189, is that what this piece, I own 3 shares, so tell me what that is. All right? Don't steal my paper. All right, that's my whole retirement plan right there. Okay? So I'm hoping to be able to walk in there to Disney when I'm old and go, I need you in, please, my ticket. Okay? So there are two primary markets, the stock market, there are 2 primary ones. Who's heard of the New York Stock Exchange? Anybody? Okay. How about NASDAQ? Anybody heard of NASDAQ? Okay, it's a big one. All right. Now look, these numbers are a little bit hard to track and hard to find because they vary all the time. How many companies are traded, whatever. All right, I'm out of frame. But somewhere around 2,800 on the New York Stock Exchange, somewhere around 3,300. So roughly around 6,000 publicly traded. Okay, they're open to the public. They move around. You can buy them anytime you want. Okay, companies out there. There are thousands and thousands and thousands of private companies, right? There just are. They're all over the place. Okay, but these are the publicly traded companies. And so the stock market kind of helps move that money. Because otherwise, how would you know how to buy a Disney share? Would you know? No. You need some kind of marketplace to buy and sell these pieces of paper. And that's what it was. That's how Wall Street started. Okay? They used to go to a corner on Wall Street and in the 1700s, and that's where they would do their investments. And they finally kind of got together and said, you know, if we just kind of like got all together and made our own building and everything, we could not get off the corner, okay? We could trade these things out of the rain, okay? And that's how it kind of got started generally. But did you know there were other exchanges in the United States? Tons of them. Not just in New York, Chicago, Boston, Philadelphia. All of them have little specialties. Some trade, you know, small, tiny little penny stocks, some bonds, some commodities, some all that stuff, okay? Lots of different places to trade stuff, other exchanges. So who's heard of the Dow? Dow Jones. Anybody? These are all terms I want to expose y'all to, okay? And this is where like the Wizard of Oz starts to come in. Okay, I want you to pay attention to the Wizard of Oz. You know the Wizard of Oz? Got the man behind the curtain, okay? This is where this stuff starts to play. And this is where it's real important. So who thinks that when the Dow goes up or down, that's the sign of the economy? Feel good about it, bad about it? When the Dow goes up, do you feel good about the economy? Okay, they lie to you. When the Dow goes down, do you feel good about bad about the economy? Okay, they lie to you. It has nothing to do with it. Look, there's 30 companies in the Dow. 30. How many companies are publicly traded? 6,000. That's just public. That's not the private ones. 30. So when those 30 companies go, and listen, let me tell you something. It's not even exactly those companies. Okay? You ever watched your mom bake a cake where she puts stuff in, stirs it all up, slices it all up, and then out poof comes the cake? That's how the Dow gets calculated. It's just like that. Okay? They decide how much who goes in, how much goes in, and how much they actually put in the pan before it gets baked, and that's what the number is. Okay? It's not like you add up one share of each of those 30 companies and that's the Dow. No. It's 5% of this, 3% of this, 2% of this, and oh, by the way, divide by a number that we picked. That's the Dow. And it changes. So the Dow's been around since the 1800s. So here's the problem that I have. I want you to look at these companies. Tell me which one of these was in the 1800s. Intel, Microsoft, Verizon, they have cell phones in the 1800s. Okay, Nike, Visa, Walgreens.
Coca-Cola, Chevron, maybe?
Maybe, right? You see what I'm getting at? Okay, so has the Dow increased since the 1800s? Yes. Well, what happened to Sears and Roebuck that used to be on there? They're out of business. What happened to United States Leather Company that used to be in the Dow? It doesn't exist. Right? You starting to see the man behind the mirror? Okay, starting to see that? So these are the 30 companies that if they go up and if their multiplier's right and everything, the Dow goes up. Okay? So this is what, now listen, this is my insight into y'all. Because you're going to sit in front of a stockbroker one day, some kind of financial advisor who's really a stock sales guy. So when you hear you need to talk to a financial sales advisor, I want you to hear stock sales guy, because that's what they have to sell. And he's going to put a chart in front of you, or she is going to put a chart like this in front of you. And this is the Dow. This is the Dow since like 1900. And he's going to go, look, the market is always over time increasing. Look at that. He's going, wow, man. And they'll say, if you invested $1,000 in 1900, it would be worth $1 gazillion today. Right? That's what they'll say. That's what they'll say. And at first, I wasn't alive in 1900. Okay? And if I was, I probably wouldn't be alive in 2021. So that comparison really doesn't help me. But at the same time, where's inflation in here? Is the value of the dollar in 1900 the same as the value of the dollar in 2021? No. Where's Sears and Roebuck that's out of business, basically? Where's that? Where did Microsoft come into here? Right? Probably somewhere in here where it starts to shoot up. You're exactly right. Okay? So if you took those variables out and you looked at the Dow and you kept the same companies that started in the late 1800s, which I think was like 20 companies, not 30, what would the Dow look like? Probably look like this. Whoop. Makes you think, doesn't it? So what should you take away from this? Do you think that the people who run this index wants it to go up or down?
Up.
Up. What do you think they're invested in? So do you think that they want the public opinion to feel like the stock market should go up over time? Heck yeah, they sell these things. The same people that produce the chart sell the stocks. Okay, this is how it works. So if we know how it works, we're good. Right? You understand it. Don't be sold a bill of goods. Go in educated, because education is power. Right? So let's talk about the next index that's real important. Standards and Poor's. S&P 500. Now, this is how many companies? Guess. Just take a guess. 500. Woo! Woo! Good job. Okay. Better than 30? Yes. Better than 30. Do I feel better about the economy when the S&P 500 goes up?
A little bit.
Do I feel better?
A little bit.
Yeah, they lie to you. Do I feel bad when the S&P drops? Do I feel bad about the economy? They lie to you. Okay? It's not how this works. Okay? Because A, it's just 500. It's just 500. A, right? That's part A. The other part, let's think about who gets to decide who's on the list. The Wizard of Oz. They meet every quarter. Okay? Now look who's on the list. Same thing. Look at it. The 10 largest companies that are on the list. Who is it? Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google. That's Google. Tesla, Berkshire Hathaway, we're going to talk about that. That's a good company. That's Warren Buffett, JP Morgan, Chase, Johnson & Johnson. Okay, so this index was started kind of in the 50s generally. It had some heritage back before that, but kind of generally in the 50s. So how many of those were in the 50s? Maybe Johnson & Johnson, right? Tesla wasn't. So here's what happens. Here's what happens. As a company has a rise in value, meaning that Suggs is willing, like GameStop. Ooh, watch out, okay? Because GameStop is based on price and number of shares. That's all it's based on. Do they sell anything? Doesn't matter. Do they own anything? Doesn't matter. All it is price and number of shares. Out. That's all it is. So if you have a meteoric rise in value, like Tesla, right? They're still trying to find their way. They're at the top of the list. Out of 500 companies, they're still trying to figure out how to make money and have a good company. He's doing a great job, but dang, right? And he's at the top of the list. You know why? Because somebody liked him, and it sold, and those shares went up, and he came on the list. Now listen, here's what happens. When you make the list, other companies have to invest in your stock, because there are businesses out there that sell product that track this. So they have to have the same shares that are on the S&P. So instantly all this money goes into your business, and then your stock price continues to go up. Right? The other part of this is that I really like though, this is the good thing, is this thing self-cleans. Meaning that if a company comes out of favor and their stock price starts to really fall, they come off the list. So over time, here's what the stock sales guy says. Look, the economy's doing great. No, not really. Okay? Because the bad stuff fell out. The list doesn't stay the same. The list changes all the time. All the time. Right? As a new company gets into the top 500, the list changes. Right? Now look here in 1994. Guess what happened in here? Computers. Microsoft. Right? So look, you got this hum, and then all of a sudden, here comes the dot-com revolution. Right? And all those companies that owned nothing, that had no revenue, right? They only were like the redheaded stepchild, whatever you call it, the favored child, right, of the stock market. All that value went in, and they all came online. That's the Googles, the Apples, right? All those stuff, right? And boom, up. Then the dot-com bust, right? They fell down, but then it came back up. Up again, it's 2008, right? That crash. But remember, listen, we know that there's a man behind the mirror. We know there is. They're pulling the levers. They're deciding who's in the list, who's not in the list. And then they turn around and they go, look, the economy's doing great. Y'all should buy my stock. Right? But they want it to go up, so it's okay. So does that mean it's okay to buy it? No. They're going to force it up. That's how it works. Okay? So how do we protect ourselves from buying the wrong stuff? Because remember, risk and reward, right? It's this term called diversification. What does it mean to diversify? Yes, Jacob.
It's when you put your money into different forms of stocks and bonds, different kinds of way to make money.
Spread it out. Okay? Would I take all my money and put it in Disney? No. Dude, they just went through a pandemic, man. Nobody could come to the amusement parks. Okay? I bet you that took a hit. You think Disney had a little bit of a hit? Yeah. Kind of tough. Right? So I wouldn't put all my money into here, but I might put my money into there. Ooh, terrible example. In there. But it's a good thing I didn't put all my money into this one. Right? That was tough. That was a good idea. That was a good idea. I lost a lot of money now. But not all your eggs should be in one basket. Okay? So let's talk about that a minute. The Bible has something nice to say about that. Okay? Here in James 4:13-15. Now listen, you who say today or tomorrow we will go and we will go to this city or that city and spend a year carrying on business, make a ton of money, right? This is our plan. This is what we're going to do. Right? Why, you don't even know what will happen tomorrow. What is your life? Right? It's just an instant. Just an instant. You're a mist that appears for a little while and then vanishes. Instead, you ought to say, if it's the Lord's will, we will live and do that. Okay? Because we don't know what tomorrow's going to bring. We don't. Right? We didn't know there was going to be a pandemic. We didn't know that in 2008 that the housing crash was going to happen. We didn't know in the roaring 20s that they would crash in 1929. We didn't know that. Okay? We didn't know that the dot-com bust would happen right before 9/11. Whew, that was tough. Right? We didn't know all that. But in Ecclesiastes it says, invest in 7 ventures, yes, and 8. You do not know what disaster may come upon the land. So spread your money out, people. Spread them out. Okay? Diversification. How do we do that? Well, if we like paper, maybe we buy a mix of stocks and bonds. Right? Maybe we buy a mix. They kind of balance each other out. It's a good mix. Maybe I buy more than one company. Would that be good diversification? Say yes. Okay, yes it would. Okay. What if I buy stock in some tech companies, some automobile manufacturers, maybe some banks, right? Different mixes. Right? My stock portfolio has finance, it has medical, it has manufacturing, aerospace, okay? Has all different kinds of stuff. Some local, some not local. okay? So it has all kinds of stuff in it. Maybe it's just different types altogether, different classes, paper and non-paper, right? Maybe it's paper, stocks and bonds, and maybe it's some real estate. Would that be diversification? Would it be diversification to say, hey, I want some U.S. companies and I want some international companies, right? That's diversification, because what if we had major economic troubles over here, but in the UK they were good? Would that be good diversification? What about a mutual fund? Mutual fund's like a mix, right? Could that be just good diversification on its own? Right? It has multiple companies. You'll even see funds that maybe they invest in international stuff. Okay? So good diversification. Does everybody get that? So what do we want? Diversification. Who'd like to see my diversification?
Me.
Would that be of interest?
Yeah.
Jacob would.
Yeah.
Jacob,
Hurry up.
because Midas gets to inherit all this stuff. All right, my dog.
Who do you love more?
Midas is my favorite child. If anybody asks, I'll tell them. Midas gets everything. Okay, so the wise person would love up on a Midas, and Midas will choose them as his next roommate. Okay.
Midas loves me.
So this is my mix. This is my mix. Now listen, I already told you that my bestie is real estate. That's how I love to invest my money. Okay? I find that I get good returns, better than the stock market. Okay? And we can talk about it, but it makes income. And I'm a big believer that my investment one day should give me income. I shouldn't have to sell my investment to put money in my pocket. That's a big takeaway. Okay? You should not have to sell your investment to put money in your pocket. Write that down. Okay? You ought to find an investment that puts money in your pocket without selling it. Okay? So my mix is like this. I have about 53%. This is net worth. Net worth. So absent any loans, anything like that, 53% of my worth is in real estate. Then about 4% is in cash. Right? We talked about that, right? This is my savings emergency fund. About 4% of my entire net worth is in cash. Then I have 11% in just stocks and mutual funds. I can get to it any time. Sell it, no penalty, nothing like that. And then this 4% is my retirement fund. Meaning I can't touch that till I'm old. You think I'm old right now, but the government says I'm still too young to take that money. Okay? Or they'll slap you on the wrist, charge you a penalty and taxes. You can't touch it. Okay? Now I chose. This is my choice. I don't like the government telling me how I should invest my money.
Amen.
I just don't. Okay? But all kinds of rules. Tell me that I can't put but so much. Tell me I can't take it out but so when. So I told them that's fine. I'll just give you 4%. Okay? Well, the rest of all this, I'm dealing with it however I want. Because I'm the manager for God's resources. Okay? Does that make sense to everybody right now? So that's my mix. The other 28%, yes.
If you work for a company that matches,
Oh, we're going to get there. Yes. Different.
it's automatic.
It's automatic. It's a great return. Yep, absolutely. Yes, Jake.
Let's say everyone else in the family disappears mysteriously. How much do I get? You can decide if you're worth keeping around.
If everybody disappears, you wouldn't know where to go to get it.
This is on recording.
You would get nothing. If I were you, I'd butter up to Miss Sherry, because she would be the only one to know how to get to anything.
Sherry, I'll bring you
Okay. Now the other 28%, the other 28% is in private companies. Some of these companies I own, some I don't own. Okay, and the value of that is mostly in cash. I don't value my companies except for what I invested in it, and it's in cash. Okay, so you see right now I've got a lot of cash in these other companies. Right now. Okay, that's just how I roll. That's how I roll. That's how I invest. So from a quick, I need money, right? Because that's what we talked about, saving versus investing. I can grab 4% right away. I go to the bank, and with a lot of paperwork, I can request a withdrawal of 4% of my entire net worth right today. And tomorrow. It's after 5. Okay, take a minute. All right? And then this other 11%, in about 24 to 48 hours, I could cash out. I'd have to call some brokers, sell some stock, get the money moving. But in a couple days, I could get another 11%. So 15% of my entire net worth I can get in just a few days. Right? So if everything goes bad, I lose my job, somebody gets hurt in a car wreck, somebody needs help, at 15%. Okay? That's just my mix. And then if I really had to get to that other 4%, I'd just pay the tax and the penalty and I'd take it. Okay? Because if that means things are real desperate. When I get into 53% down here, that's in real estate. This is not liquid. You can't do anything with that thing. Okay? You're just not going to sell it in a week. It's just not going to happen. But that's long-term money. Is that good?
Yeah.
It's good, right? It's good. But I need short-term money just in case. So I wouldn't ever do 100% real estate because then I'd have no cash, right? I mean, I'd have a flat tire. What do I have to do? Sell a building? I mean, that makes no sense, okay? Why are you selling, Mr. Lavery? I need tires, okay? No, that's silly, okay? You need some cash. You need some cash. You got to be able to handle that, okay? So you do. So that's my mix. Now, was that my initial mix? No. No, right? When I was your age, what does everybody normally start with? Does anybody know? Huh? Cash. And then what? You start a job. Some kind of 401k, some kind of retirement, some kind of like that, right? So you guys are probably going to start with these two sectors right here, or these three. Your cash savings, some kind of investment we're going to talk about in a minute, and then some kind of retirement plan. This is your start of your mix. Does that make sense? Any questions about that? Okay. Now, over the last few weeks, you guys have had some questions. In fact, starting right out of the gate, Suggs was like, what do you think about crypto? And old Tucker was like, what do you think about debt? I mean, dang, it was like first night. I didn't even walk in and warmed up, okay? So you've had some questions. And I've answered some of them, and we're going to get to the rest of them tonight. So I made a whole section on common questions, okay? Common questions. Tucker, no debt, okay? We got that out of the way. Boom, done. Okay. Suggs, no crypto, okay? Just kidding. Just kidding. All right, so let's just dig into crypto real quick, because I'm going to talk about that. Let me back up. Let's talk about crypto. Look, here's the deal. Yes, Jacob was ragging on me just a little bit ago because he told me that if I'd let him buy Bitcoin at $100, he'd be worth 50 some odd million right now. He wouldn't be living at home. I was like, bad on me. Okay, I had a chance to get rid of him, and I missed it.
It's not going to work.
So I missed it. Listen, here's the deal. Okay, I don't consider that investing. Okay, not in the biblical investing of slow and easy and steady wins the race. That's what the Bible preaches. The Bible talks about nice, steady, even investing. Okay? Now look, in some real estate deals I've done, it's quick money. Okay, in and out. And I can do that too. But I have in the background my nice, slow, and steady. But I know in the back of my mind that if I lose all the money I just put in that deal, it's okay. And I would treat that the same way. Okay? If I were to go and invest in GameStop when it was on that meteoric rise, it'd be like, all right, I'll throw $100 in, see what happens. But I'm willing to lose 100 whole thing. It's more for fun. Okay? It's almost like going to the craps table in Vegas. Right? You might win, house is going to win. You know they are. That's how they get the big hotels. Okay, just so you know, the house always wins. That's how they get the big hotels. That's it. You don't see a casino at a small Holiday Inn Express. You ever seen that? No. Okay? So that means they're making money somehow, and it's not from the buffet. Okay? It's not from the $5 buffet. So if I were to do that, Suggs, it would be like, okay, look, man, I have an extra 100 somewhere, right? And I could throw it in and see what happens. And if I lose it all, lose it all. If I don't, okay, good. But that's not what I call investing. Okay? That's more for fun. There are people that invest and they day trade and do all kinds of stuff. They do commodities, they do real high risk things. And with education, you might one day want to do those things. It's just not for me. Okay? Because I'm a steward. This is God's money. I'm managing it. And I don't want to risk it that way. I don't want to go up and stand before him and go, dude, you really blew that one. I'm like, yeah, I did. Okay, right? I want him to say, well done, my good and faithful servant over all things, including this. Is that fair? Okay. So common questions. Okay, look, I get asked this a lot. Greg, should I invest in an IRA, a Roth IRA, or my 401k? Okay, what should I do? And the answer, just like any good engineer is, it depends. Okay, if you ask a good engineer, should you do anything, he'll be like, it depends. Okay, that's how it is. Now, these are all tax code based type things. There are rules and restrictions upon each of these funds. Everybody buys that? We get it? Okay, the government has dictated, partnering with some sales guys, on how these things work. Okay, the 401k actually came out of a tax code called 401 paragraph K. Okay, and a sales guy found it in the tax code and said, ooh, I could sell a thing around this whole thing right here, and launched an entire industry. Took one little paragraph out of the tax code and built a product around it and went and sold it all over the place. That's what it is. Okay? Same thing with the IRA and the Roth IRA. Okay, these are sales guys sitting around the table, they read the tax codes, they go, ooh, I can sell this. Okay? Nothing wrong with it, good stuff. So let's look at some of the differences. Y'all want to do this? Is this boring or good stuff? Good stuff? Okay, all right. So here's the caveat though. You know what a caveat is? Kind of like a little point you should consider. Okay, the caveat is that all these plans have some restrictions as your income changes. Okay? When you start getting into big bucks, okay, big boy money, some of these plans might not be available to you. Fair? Okay? And some of the deductions start to go away. Right? So whenever anybody says, hey, the rich people don't pay their share of taxes, well, yeah, but they lose a lot of deductions as they get higher too. Okay? So there's stuff that they can't take advantage of that other people can. Yes, Casey?
What would happen to your 401k if you left the company?
Oh, good question.
Got
Good question. So let's start at the 401k. Let's start over there. Usually a 401k is managed by your employer. So you start your first job out of school, whatever, right? And they go, hey, listen, we have this retirement plan you can participate in. It's really cool. Okay, it's called a 401k. You're like, great. Now some 401ks, they match. They match. Meaning if Chris is my boss, he says, listen, if you put in 5% of your pay, I'll put in 5% of my pay. My pay. Okay? I'm like, ooh, cool. Well, then I'm in for 5. Because if I can put in 5% and he matches me, I just doubled my money without doing anything. You get that? Right? I put in 5, he puts in 5, and I got 10. I doubled my 5, and I didn't have to do anything. Right? That is a good deal. It could be a bad deal if that $10 is invested in a company that doesn't work. Okay? But if it's invested in like a mutual fund or something with a real track record, right, then it could be a real good investment. If I started a 401k at my business, I said, hey, I'll give you a share of my stuff, right? Well, I'm printing mine for free. It's like the federal government printing money. Okay, I can print these shares all I want. Okay, so you're going to buy some shares with your money, and I'm going to print mine. Okay, and then the company goes under, and you get nothing. So you just have to ask, and we're going to talk about that. You're going to have to ask a few questions, like what's it invested in, and do you match? If the match is yes, then yeah, I'm investing. Now, what happens if I leave the company? Kasem says. Does anybody know?
It transfers over.
You can roll it. You can roll it over, typically to an IRA or a Roth. Typically, how that goes.
So just backing up a minute.
Yeah, back up the bus.
How do I do that as an employee? Can you just? I mean, you said it, but like, do I go to the HR person and say? I mean, can you kind of share?
Yeah. So typically, it's in your offer package. Like it's in your when they sit there and they go, okay, fill out all this paperwork. Do you want dental, medical, health insurance, life insurance, all that stuff? It's usually part of their overall benefits plan. But if you don't know, or if they told you and you didn't even know what it was, because it could be as simply as like, do you want to participate in the 401k? I don't know what that is. No. right? So it's okay. It's okay. Now you know, right? Education is power. So now you can go back to the HR department and go, hey, was there a 401k offered with my job? Some kind of retirement plan, something like that? Does that exist here? And they go, well, yeah, it does. Okay, well, cool. I'd like to sign up for that. Okay, I'd like to sign up for that.
And Greg,
And I'd like to read it. Yes.
they would just deduct that out of your paycheck.
Yep. Just
every
comes
time
right
you
out.
see it.
You never see it. It's kind of like, gross pay, FICA, all those deductions will be 401k. Okay, and you never miss it, I promise.
You
Okay?
get a statement every what?
Every quarter,
telling you what's in there.
4 times a year, you'll get a statement saying how much is in there, right? It's just gonna grow, you're gonna get a return.
Actually, on my paycheck for the year anyway, you see exactly what
Oh.
it is and with the match.
Yeah, how much is contributed.
For the year.
For the year. But then
don't
you
see
gotta
it
go to the
for either
statement,
10 years.
and you gotta go to the statement to see the growth and everything.
That's right.
You're
A lot
right.
of times it's online.
So,
Correct.
so isn't that cool? Right? So the answer is, should I invest in my 401k? And the typical response is yes. Yes, that's the answer. Okay? Because there's a match. Now I have been in companies they don't match. I'm like, dude, I can take my money and invest it better over here. Okay? But if there's a match, I'm in. Yes.
One thing you said was, like, if you're already in HR and you're already hired, it's almost too late. You should have asked the question. You might be deciding between 2 companies, and this company has a great match program.
Yeah.
And it's 100% increase every time you put a dollar.
Yeah, so what if you go to, and you're interviewing 2 or 3 different jobs, right? And what if the pay's about the same, but one has a really good retirement plan and one doesn't? Is that worth something? Yeah. In fact, I would tell you that, who'd like to be like a fire department person, fire guy, police guy, teacher person, anybody like that? Teacher? Okay, look, some of those retirement plans, I don't care what your pay is, your retirement plan is worth millions. Your retirement plan is worth millions, okay? If you sit there and say, like my mom, she worked really hard, she taught really hard, okay? But then she was on full medical and full retirement for years. And the value of that, right? It wasn't in a bank account for her, but the value of that income she got every month was huge. Millions, okay? Which is awesome. So kind of like a 401k, it's like a pension, all right? So that's good too.
Can you explain the pre-tax thing
Yeah.
too? Like, what happens with that?
Yeah, so across the board here, between an IRA and a 401k, they're called pre-tax dollars, okay? So let's take it like this. You know your difference between your gross pay and your net pay? Or the gross pay is the big number, the net pay is what you actually get to take home, okay? We know that? Okay, so this is all taken out before Uncle Sam gets his piece. Is that good? Yes, you know why? Because I didn't pay tax on that money. Right? If you got your paycheck and then invested your paycheck, I had to pay taxes before I got my check. And then I went and invested it. Whereas this, you get to invest it before you pay taxes. So it actually looks like it reduces your income. Is that important when it's time to go pay taxes? Right? If my income went from $100 to $10, $100 to $10, what's less in taxes? Paying on 100 or paying on 10? 10, right? So if I could take money off the top to reduce my income, my tax amount is a lot less. Good? Okay? That's the value of the pre-tax. Okay? Now the Roth is after tax. I kind of got the money, I invested it. It's after tax. But the benefit of a Roth is that later you can take it out tax-free. So all that growth and everything, you can take it out tax-free, which is cool. So that's the main difference between the traditional IRA and the Roth, is how the taxation is treated. Okay? One, you put it in before you pay tax. So technically you could put in more because you didn't pay tax on the money first, right? But then later you owe taxes on the way out. Whereas the Roth, you paid in taxes, and then as it comes out tax-free. So here's the deal. I'll get to you, Casey. Hold on a minute. Hold on. These two right here, it's a toss-up. It's a toss-up. I couldn't tell you which one to do. What's your tax rate today versus what's it going to be at 60? I don't know. What's Biden going to do versus what Trump did? I don't know. Or the next president? I don't know. Okay, it's a toss-up. Is that fair? So should I do an IRA or a Roth IRA? I don't know. Okay? In the end, the goal is to get as much in there right now as you can, because we talked about last time that the earlier you get the money in, the better. But if you only put the same amount, I don't care if it's pre-tax or post-tax, you put the same amount in, right? If you put in more because I didn't have to pay taxes on it, then I would say do the Roth, right? If you could just get more in, okay? But right now, I'll tell you today, right now, this is your lowest of your earnings, right? When you retire, the concept is that's the lowest of your earnings. That's the concept, not my idea of a good time, okay? I want to be the highest of my earnings when I retire, because I'm kind of retired now. So the goal, the thought there is, in my world, is like, well, shoot, if your taxes are so low, why do you care? Go after tax if you want, okay? And that's the sales guy angle. They'll say, oh, well, you can withdraw this. You go in pre-tax now, and you withdraw it later when your taxable income is lower, so you don't pay as much taxes going out. That's how they sell it. But you don't really know that. The government changes tax rates fairly regularly, okay? So you don't know. But either one's good. But the deal is that you can see here, they control how much goes in per year. You're maxed out. Now the number's pretty good, but it's not enough. We talked about that, right? You want to do as much as you possibly can, right? So they limit you going in, and then they talk about when you can bring stuff out. And I just don't like that kind of control. I like to be able to manage a little better. Questions about that? Because I know there were questions earlier. Casey, I'm sorry. What's your question?
When you transfer a 401k to a Roth IRA, is that amount in the 401k still taxable? And
You're going to put it here.
how much?
You're probably going to put it in here.
But how can you transfer it all if you have more than the 6,000
That's okay.
limit?
They look at it as a rollover. A rollover has different rules, Casey, than a contribution. And typically you roll it into a traditional IRA.
To roll a traditional 401 or 403 over to a Roth, you got to pay serious penalties going in.
So you would rather,
do
that's
that.
why I'm saying you would rather go here pre-tax to pre-tax. Because then there's nothing. It's almost like getting a brand new bank account and you move the money from one to another. That's
Or
it.
start a separate Roth, because one of the advantages, you look at the penalties or the restrictions down here, one of the things with a Roth IRA is you can take money out for education without penalty.
Yep.
So to pay like a kid's college education, you can take a portion of it out without paying any tax penalty, where over here, you can't take any of that out, or you're gonna get hit with a major penalty
Yep.
and tax.
There's
tax on
10%
that.
penalty plus your income tax. Yes, Jay.
Okay, so what was it, the Roth IRA that you can take out for education? Can't I just, if I have a lot in there and I don't want to have to pay a penalty, can't I just pay the school, cancel the tuition, and take it back to my personal? Would that in theory
Are you
work?
trying to say you just will live in the dorm without going to class? Okay, because that's what I think you're trying to say.
I mean,
I'm
you-
not, I mean, you know.
Yeah, no, that's not how that works. All right, you're a knucklehead. Yes.
Where are you gonna like post like the videos that you're recording like right now?
Oh yeah, so they're up on YouTube, but they're kind of unlisted. So the
Okay.
links are being mailed out by Kevin. But actually, tomorrow they're getting uploaded on my website, therocketguy.com,
All right.
under pre-recorded live events.
Thanks.
Yep, so those will be out there. All right, so this is the other question, and we kind of touched on this. Should I invest in my 401k? Okay, when you're thinking about this, when you go before the HR department or whatever, okay, is the employer going to match? Do they match? That's the question. You can sound very intelligent. And that is why I'm wearing my blazer tonight, because when you talk about money, you're supposed to dress up a little more, right? So we're investing, so we're going to dress up a little bit more. So you can ask and sound very intelligent. Do you offer a match for the 401k? I'm like, dang, man, they know something. Yes, I do. Okay? And sometimes they'll have what's called a scaled match, where they'll do like dollar for dollar up to 5%, and then they might do half match up to 7% or something like that. So there might be a little step in there. So usually what I would say is definitely go match dollar for dollar. The rest is kind of a you choose. Do you want to go up a little bit more? Do you want to give a little more? Okay, that's a you choose. And then what is it invested in? Okay? Did Chris just start a company? He's like, yeah, we have a 401k. You just, like, you're buying stock in my company. Okay? Is that what it is? Or is it some kind of mutual fund or some kind of big fund that you can buy into? Because that's really what you want. You want something kind of stable with a track record. If the answers are yes and yes, I'm all in. And can they offer flexibility? Meaning, remember, diversification is important, right? Well, this is what I didn't tell you. The mix of that diversification can change with age. Okay? When I'm young and I'm okay with more risk because I don't need the money right now anyway, I might be all stock, all in, push them all in, go, high growth. Okay? I want as much growth as I can. When I'm old and I don't want a lot of risk, I might be, easy cheesy. Okay? Don't go, bonds, something conservative. Almost ready to put it into a savings account. Okay? So you want something that maybe you can be a little flexible and change what's inside that 401k as you age. Is that fair? Good? Okay. Good. All right. So I know everybody's excited. You're going to go invest, aren't you? Going to go invest? Yes. All right. So how do I get started? You do something. Okay? This is how we get started doing anything. We do something. Okay? So here's what I would recommend. Who's ever gone to E-Trade? Anybody know? E-Trade? 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 Anybody E-Trade? Something like that. Okay? Something that has very little fees associated with it. Robinhood, E-Trade, something easy. Okay? You don't really need to sit in front of a financial advisor that you have a little nest egg growing. Okay? Because they're going to start charging money. They're not sitting across the table from you if they're free. Is that fair? They are not going to sit across the table from you and be free. They're going to charge somebody some money to talk to you. Okay? So until you have a nice little egg, something like an E-Trade account is easy. Easy to do. And then remember what I talked about with the S&P 500. Which way does it go? Up or down? Up. Okay? There are funds you can invest in, and I gave them to you last week, and we're going to look at them again, that they mirror the S&P, right? So you can buy, for a few $100s, you can buy one share of this fund, and it's going to travel with the S&P. Easy. I don't even have to think, because it's going to go up over time. Might not go up tomorrow, might not go up next year, but over time it's going to rise. Is that fair? And you don't have to really think about that. That's how we kind of get started. Is that a good way to get started? The other way to get started is to ask your employer about a 401k or some kind of pension retirement plan. Okay? That's another way to get started. Then you want to get on the habit of getting some kind of paycheck or bank account deduction every month. Right? We've worked our budget. We've made room in our budget for investing, right? So just have that stuff just happen automatically so you don't have to think about it. Right? The earlier you get started and the more I do, the better I am long term, right? We talk about that every month. Okay? And then seek education. Because one time, someday, there's going to be some investment opportunities and you want to be open to them. Right? Somebody is going to come up with a pressure washer and go, would you invest in my pressure washing business? Right?
Right.
Okay? Somebody's going to do that, and you're going to sit there and go, oh, pressure washing business. What's that going to bring me? Okay? And you're going to say, well, are you going to sell me some equity in your company, or just want a loan? Right? And you can talk that way because you can learn and you can have other opportunities one day to invest. Doesn't have to be just on some kind of simple S&P 500 because you're going to get the better returns other places. Because as an investor, we're trying to match risk and return, right? Risk and reward. And sometimes better rewards are out there that you come across. Is that fair? So education is the key to all that. And then when do I start? What did we talk about?
Start as soon as
Now, as soon as you can, right? Because the difference between now at age 20 and age 30 is about $600,000 when you turn 60. Okay, investing $500 a month at 7%. 600,000. Now, I don't know if you got it last time or not, but I kind of threw out something that just hit me when I was looking at the screen, which was, hey, look, if you have a car payment that's $500 a month right now, and you can't invest because you're making that car payment, you best sell the car, because that car is costing you $600,000 when you turn 60. Okay? If you delay this investing by 10 years, that same car that you paid $30,000 for costs you $600,000 later. See the importance of that? Now this graph does change if I get better returns or worse returns, right? This is 7%. So what if I could invest in some mutual fund that gave me 10? What would that be like? So instead of like 1.3 or 4, maybe it'd be 2 million. That's a big difference, right? Just a few percent over a period of 30 or 40 years. It's a big deal. That's why we want to pay attention to how we're balancing out the risk and return. That's why we want to pay attention to when we start. And we're going to start today, right? Okay, start today. Do we all feel like we could? Do you all feel like that you could at least play with it and see? Because I like to kind of paper trade, is what it's called. And it's kind of fun. Because you can actually buy something without buying anything. Right? All you have to do is look at the price it's sold for, mark it down, write it down somewhere, right? And then watch it for a couple weeks and see what it's doing. So let's look at these. Did anybody track these on their phone? Hey, how much is my Disney stock, by the way?
$169.
169 times 3? Woo! 2 claps. Woo! All right, pizza. Pizza on the bonds right here. Pizza on the bonds, baby. All right. So that's good stuff. Not bad for getting it for free. All right, so these first 2 funds, IVV and VOO, one's Vanguard, IVV is something else, it cost shares or something. So you can see the last time I spoke was 5.3. I took the price on 5.17, and you see we lost about 1/3%, 0.38. 0.33 is 1/3. Okay, trust the rocket scientists in the room. Okay, so we lost about 1/3% over a couple weeks. That's okay. We can make it up, right? But these guys, this is the point. This is the point. These guys are supposed to mirror the S&P. The S&P's at 4,000. I could buy that for 400. So is it easier to buy a fund that moves with the S&P, or is it easier to buy the S&P? A fund, right? It's cheaper. It's just like 10%. I could buy 10 shares of that, right? Yes, Tucker.
Now, can you put like $100 into the S&P 500?
You have to buy this.
Yeah. Okay. I didn't know.
Yeah. If okay, here's the deal. There is a stock called the S&P 500 which mirrors exactly this, but then there's these other index funds, exchange traded funds, ETFs, or index funds that mirror this. So whenever a new stock is added to the S&P, these guys have to go buy it. And then they kind of break it up and they go, okay, I've got about $4,000 worth of value, so I'll sell you 400, you 400, you 400, right? And they sell 10 shares to make it up. See, that's how they do. Okay? So you can see very, very close to the same performance. Okay? Casey?
It's that BOKA Berkshire.
Oh, Berkshire A. Berkshire A. Now, I put this up for fun. Okay? Because if you got a bunch of money, convince your parents to sell their house, you can buy 1 share of Berkshire Hathaway for $437,000. Okay? Now listen. Listen, Berkshire is inside the S&P. Okay? Berkshire's inside. That's Warren Buffett's company. If you don't know him, kind of rich dude. Okay? Old, rich. Okay? Married, sorry. But old and rich. All right? So, but listen. If you want to track what the economy's doing, look at Berkshire. Because Berkshire owns hundreds and hundreds of companies. And they own all different kinds of sectors of companies. Geico, little small insurance company, y'all know Geico? Berkshire owns them. Okay? I think Union Pacific Railway or Santa Fe. Union Pacific. Berkshire owns them. Okay? The train. Okay? They own all kinds of different companies. They have one company called the Marmon Group. The Marmon Group itself owns 200 companies. Okay? So if you want to track kind of how the economy is doing, Berkshire's a good indicator. And look, just in about a 2-week period, they went up by 4% in 2 weeks. That's huge returns. So if I paid $420,000, I just made 17 grand in 2 weeks. Woo! How about 2 claps? Okay? 4% in 2 weeks is huge. Do that math times, divide by 2, 52 times 52. What does that work out to be? A lot. Okay? Maybe 100% a year, give or take. Okay? Right? So, good stuff. Right, that's really good stuff. So if I like to track the economy, I look at Berkshire. Because that's a good cross section of all different kinds of industries, and he's running a good company in there. Okay? So you can do this for fun. I know, kind of geeky fun, right? Like, oh, I just sit around and do math problems all day for fun. Okay? But that's kind of good geeky fun. If you're kind of just trying to figure out, okay, what would I like to invest in? Because this didn't cost me anything but time. I just put a little spreadsheet together, write on a piece of paper, whatever, and see. Did it go up? Did it go down? Fair? Do a little research. Kind of fun stuff. Questions? Who's got a question? This is deep stuff, guys. It's hard. Yes, Tyler.
So Berkshire Hathaway, since when I go to the economy, then why don't you invest retirements?
You can. You can actually buy an index fund on Berkshire. Right? The problem is that not all of Berkshire's investments, like if they're trying to match investments versus they paid $420,000 and it's split it up between 400 people, right? There's 2 different ways. So if I'm indexing, I might buy the same stocks you might. Okay, that's one way. The other is do kind of like a fractional sharing, okay, where they bought 1 share and then they split it out. So, well, okay, there's nothing wrong with the second method. The first method, Berkshire owns private companies, so there's no way I could buy that same company. Is that fair? Okay, but if I bought a share of Berkshire and then I sold its ownership across 10 people, you know, that'd be okay. Kind of fractional sharing. Yes.
So if I bought into a public company, do you have to go through the stock exchange, or could you just go through like Robinhood or Webull?
It's the same. That's just a brokerage account into the stock exchange. Yep. So you can use Robinhood, and Robinhood's going to bundle all that up together and then market it out on the stock exchange. They're actually packaging it all up and then brokering it out.
How do you get into real estate investing?
Oh, that's a loaded question.
I mean, are there companies that will let you jump in with them and loan some of your money or make payments into that?
Yes, so, all right, so a couple different ways. There are real estate investment options on the stock market. Easiest, okay, they're called REITs, Real Estate Investment Trusts. You can invest in real estate by buying a share of a REIT. Easiest way, right? The other is, gosh, that's 25 years ago, Kevin. That's all right. Yes, you can get good tutoring and mentoring, and you can learn real estate investing, and you can get education. You can even look at my channel if you really wanted to. Be one of the 56 subscribers or 65 subscribers.
What about private people? Like, what if you went to somebody and said, "Hey,
absolutely. There's private money all over the place, and there's also what's called hard money lenders out there. Their interest rates are a little taller, but they'll loan on those deals, and you can go in with no money down. That's how I did. I wouldn't advise that, but you can. But where I would start is here in the paper assets. The paper assets are the easiest way to get started. You could start with $50, $100 a month, and it doesn't take much. Once you have a nice little nest egg, then you might look at some of the other types or classes of investments, like real estate. Maybe you go out and get some gold or some kind of metals, precious metals type stuff. You might diversify that way.
When it comes to like real estate and building, would you think housing, or are you thinking apartments, or are you thinking like malls, strip malls?
Most young real estate investors start in single family homes because that's what they know. They lived in a house, they can buy a house, right? Most real estate investors aren't going to necessarily start from, I'm living in an apartment and I'm going to buy one, okay? It's just too big of a leap. But remember, with education and practice, anything's possible. So when I was 26 years old, have I told y'all the story yet? How I started investing in real estate? Would y'all like to hear that?
Yeah.
Would y'all like to hear that? Casey, can you hold your question? Cross your fingers. That's what we do in my office. I have a question to hold. All right, because I'm holding it. All right. So here's how I started. You want to hear how I started investing in real estate? Okay, here it goes. I'll make it a short version. Okay, so one night, it was a Sunday night, okay, and I lived in the projects.
Yes.
I was 26 years old. I lived in the projects. I drove an Acura Legend, which back then and that day was the whip. That was it, dude. Okay, and my car payment was like $500 a month, and my rent was $395. Okay, because that's as a guy, that's how we roll. Okay, we show up, tinted windows, nice rims, nice interior, CD changer, because that's what we had back then, CDs. Okay, but it was a changer in the trunk, so I didn't have to pop them in and out. Okay, so I was high class. Okay, that's how we roll. And every time I rolled in my parking spot, everybody upstairs in the balcony would look over and go, "Man, you got a nice ride." I'm like, "Yeah, I do. And I'm gonna go to the project. I'm gonna go to bed." Okay, so one night on Sunday night, little knock on the door. Okay, it was a local drug dealer. Now listen, that was his profession. I didn't hold it against him. I knew it was him because his girlfriend was next door to me. Okay, and he would line all his customers up on the balcony, and he'd sell right there out front of my apartment. So I knew when he knocked on the door and I said, "Hey man, what you want?" He said, "I want you to come out and talk to me." And I said, "Man, I've just turned out the light. It's dark. I'm ready to go to bed." But no, I want you to come out and talk to me. And I said, "Look, what are we going to talk about? Just come on out." I said, "Listen, here's the deal. Here's the deal. I negotiated. I was a good negotiator at 26. I said, I'm going to negotiate a deal. Here's what I'm going to do. Okay, I'm going to shut the door because I had a little chain on. Now I'm a 200-pound black belt, so it really didn't matter. He was pretty small. Okay, he was like this big. So I really wasn't afraid of him, but I thought if we're going to have a serious conversation, I should shut the door, go back to my bedroom, get my 9mm, and come back, and he could talk to Mr. Ruger because I bring my gun to every serious conversation. Okay, and so that's what I offered him. And I said, I'm going to do that. He said, no, don't be that way. So I went ahead and executed on my side of the agreement. And I went back. When I came back, he was not there. I do not know why. Okay? But then I woke up the next day on a Monday and I said, you know what? I'm working for NASA. I'm living in the projects. Maybe I should upgrade. Okay? Maybe I should kind of upgrade. So I asked my friend if he'd help me find a place to live. And that was a Monday. By Wednesday, I had a contract on a little townhome. 2 flats. Woo! Right? 2 flats. Okay, that was my first house. It was April 25 years ago this last month. 25 years ago. Okay, by December I bought 50. Okay, because I got so excited. Look, this isn't hard. You just pull a little bit of money together, sign some papers, they give you a key. It's easy. Look at this. I thought buying a house would be tough. So I started reading every book possible about how to invest in real estate, no money down, all this kind of stuff. Every scheme I could put my hands on. I bought a condo on a credit card. Okay, I did. Condo on a credit card. Okay, there was one time my buddy said, yes, we'll pay you so much, all cash, close in 2 weeks. I was like, I have not that kind of cash. I'm out, like pulled my pockets out, I am empty. He said, don't worry, it's not really cash. I had to go around to like 4 banks, get cash advances on my credit cards, and I was walking out with thousands in my pocket in cash back to the car. Okay? I had to go to 4 different banks together, and I showed up to the attorney's office. I didn't know you weren't supposed to actually bring cash. Okay? And I threw out like 40 grand in cash and threw it on the table. And she's like, whoa, what is that? I said, all cash. They're like, no, you wire the money. I mean, I had no idea. I thought it was real cash. Okay? So this is how I did. That's how I started. Okay? Now fast forward, by like October, November, I bought my first multifamily. Okay, I bought a 12-unit building. Okay, it only had 1 tenant. I think I told you about them, very high qualified to manage this building. Okay, and so he was a local drug dealer. She had other professions. And so they managed this building. It was only occupied at night. And during the day it was vacant. So that's how I started. And I bought trash. I mean, these things were dogs. But I'd go in after work. I'd finish work at 3:30 at NASA. You cannot take a rocket home. I dare you. Try to figure it out. Try to take a rocket home for work. Like, I got to carry my work home. They don't like that. Okay, they have guards with guns and stuff at the gate. And they're like, you can't take anything out of here, Mr. Lafferty. I said, okay, well, I won't do any work at home then. So I'd get off at 3:30, and I'd go work at my properties. And I'd paint and clean and fix up, do repairs and everything. About 2 in the morning, I'd go home, I'd go to bed, catch a couple hours, be back at the gym at 5:30 and go to work at 7. Okay? That was my lifestyle. And I did that about 7 days a week. Boom, boom, boom. As soon as church was over, I was at Home Depot. Okay? Buying stuff, and I'd go right to my rental properties. And I did that over and over and over and over. Okay? So that's how it worked. But the flip side of that was I had this train of debt and craziness, okay, trailing behind me. And I told y'all, right, in honest confession night, first night, right, I said I had like thousands and thousands and thousands of dollars in credit card debts from doing stuff like that. Because what I would do is, there's a popular method out there now called BRRRR, buy, renovate, rent, refinance, repeat. Okay, and basically what it means is you buy it trashed, you fix it up, you put a tenant in there, you go to the bank, you get a refinance, you pull all the money back out, and you go do it again. The problem is what I was doing was I wasn't paying all that stuff back off. I'd take the money and I'd go do it, and then I still had to borrow more money to do it. Okay? And so I was building up this like debt ball, and I couldn't figure out how to make the payments. And there was one night that really hit me really hard. I came home one time and I just grabbed my mail. Y'all ever traveled and you go to the mailbox right before you leave, you put it in and you take it to mama's house, right? And then you open up the mail while you're sitting around the kitchen table. I had no idea how I was going to make a payment. No idea. I didn't have the money. And in that envelope was $600 from some refinance I'd done that they rebated me. And I owed $600. And I knew right then and there that God had something for me because He was taking care of me. Right? And then it took me years to work out of that mess. And I learned how to do it smarter. Okay, and that's the whole point. So now if somebody says, man, I got a no money down scenario for you, let's do it. I'm like, nah, I'm good. Okay, I'm going to save my money, I'm going to take it, I'm going to make a good little down payment, things are going to make me money, things are going to cash flow, and I'm going to earn a bunch. Okay, but I'm not doing this gunslinging thing like I used to when I was young and crazy. Okay. So now if a young guy comes and eyes all bright, like, ooh, I'm gonna invest in real estate, I'm like, he's a killer. Woo! I've been there, be careful, okay? But good stuff, because in real estate, you can typically make way more returns than you can in the stock market. If you'll look, the wealthiest of Americans make their money via real estate or running their own businesses. Prove me wrong. Prove me. Real estate or their own business. Prove me wrong. Donald Trump, real estate. Zuckerberg, their own business. Musk, their own business. Right? That's it. So, all right. Sorry. Was that a good story? I like that. I got tons of them. All right. Check me out on RocketGuy.com. Anyway, all right. So, little plug. Any other questions? Kason, I'm sorry. Thank you for holding.
So, what's the difference if you buy into a company that's like Berkshire that's traded A and B?
Oh yeah. So they issued 2 different shares, right? 2 different shares, and sometimes they even have different payouts, right? They have A shares, B shares. Sometimes some gets dividends, some don't. I don't know what this qualification is, but they're treated differently. But it's 2 different issues. If a company needs to issue more stock, sometimes they'll issue a preferred versus non-preferred, different ways to issue it.
But I don't want to borrow money.
Do what?
I don't want to earn money, maybe just not as much as the other.
That's right. And I think their B is like $400. I mean, their B is like very affordable. But I don't know what that really was meant to do. I'd have to do my research. Why they issued it, how many shares they issued, all that kind of stuff. What the money was used for. Any other questions? Yes, ma'am.
So you talked about like like a married couple,
Yeah.
if like you take one income completely and
Yes.
give it all to investments.
Yep.
What would you just want to like diversify everything,
Yeah.
or how would like?
Good question.
What should you invest more in?
Good question. So the question is, you know, I had the dual income pay method, payday, right? So here's the deal. If and when you're blessed to get married, okay, if you are, if that's in God's plan for your life, right? Eventually you might have 2 incomes in the household, right? And so my comment was, when we were talking about that, is there's going to be some level of two incomes, right? This is your household income. This is hers and his, whatever. Okay? Then, and my comment was that if you were smart, you would at least consider living on this one and investing this one, right? Because one of you might want to stay home with the kids. Fair? Okay? So I want to budget on one, and then I want to pile in on this one. And you're correct. So all those suggestions about diversification, where it gets invested, all that is the same. It's totally the same. So the bulk of it, there's no easy answer, okay? But in your age group, it should be more like a growth, what they call a growth-oriented investing, okay? And they vary, like they say growth or growth with income, that's how they phrase it, or income, okay? At your age, you're going to start here. When you get to my age, you want to be down in here, okay? Because this is safer, low risk, low return, high risk, high return, okay? Now, you might put a piece of this into someone's 401k, okay? There might be a piece in here into the IRA or some other retirement fund, and then a piece in your cash savings a little bit as you go, a little small piece. And then the rest of this, I would probably put, like what we talked about, is either some kind of S&P fund or some kind of general growth mutual fund with a good track record, okay? Meaning 10+% over the lifetime. That's where I put it. And you would diversify because this is naturally diversified. You have all kinds of different stocks and other things inside here, plus you have different types of investments. You have a little bit of cash, you have a 401k, you have your IRA, all that, okay? That's what I would do after paying off your debt, okay? Because some of this is probably going to be used for debt retirement too, initially. Yes?
And Kaylee, like the mutual fund people, they'll show you like high growth, high return, like what those are, and they'll say you want to invest in this one because you're younger. They'll show you in there where those qualifications.
Yeah, they'll help you with that. But that's a good question. You're thinking ahead. That's good, because this is powerful. Because I could slam a lot of money in early doing that. You don't have to do $500 a month, man. Put in 50 grand a year. Pow. Okay, just throw it in there. Pow. And that's why you can't do it all in a 401k or an IRA. Okay, because there's limits, a 6,000 a piece kind of range, right? But if you're putting in 40 or 50,000, go ahead and push it in, boom, all in. Okay, some of that's an IRA, some 401k, rest in some kind of other. Okay, any other questions? Good stuff? Was this helpful?
Yes.
Okay, good, awesome. All right, people, let's stand up. Let's wrap it up. What time is it? Woo, boy, let's get out of here. It's not bedtime. All right, two claps. Give me two claps. Give me two claps. Give me two claps. Do I love investing? Yeah. Yes. All right, for Suggs, do I love Bitcoin? Yeah. All right, good. All right, good. Thanks, y'all.
I hate that. That was an actual.